In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about coal's surprising comeback and why our world is not yet ready to say goodbye to it yet. And in the second story of the day, I'll talk about a pump and dump case that has recently unfolded in the Indian stock markets. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 27th of December. Let's start with the first story and talk about how we are not quite ready for letting go of coal. See, when we talk about coal, most of us think that it's an old school energy source, something that the world is gradually moving away from. For many years now, the story has been about renewables like solar and wind taking over, which pushes coal into the shadows. But the International Energy Agency, or the IEA's latest report, Coal 2024, tells us a very different story. Now, this is a very big wake-up call for anyone who assumed that coal's decline was inevitable in the future. See, in 2024, global coal demand hit 8.77 billion tons, which is the highest level ever recorded. And the IEA, which just last year was predicting that coal demand had peaked in 2023, now says that coal use is likely to keep growing until at least 2027. And the shift in their narrative is pretty interesting. Now, you might be asking what exactly changed and why is coal refusing to fade away at all? See, the growth in coal use is largely being driven by emerging economies, especially China and India. Let me quickly break it down for you. Let's talk about China's role to begin with. See, China is a heavyweight in coal use. It is the world's largest coal consumer and they use about 30% more coal than the rest of the world combined. That alone, let me tell you, is massive. But what is even more interesting over here is how and why China's coal consumption is changing going forward. The first reason is their electricity demand. See, usually a country's electricity demand grows in line with its economy, which is measured as GDP. But in China's case, electricity demand is growing faster than its GDP. You might ask why? See, new industries like AI or artificial intelligence, data centers, and EV manufacturing are guzzling electricity at unprecedented rates. Even renewable energy production in China relies very heavily on coal-powered grids for stability. The second reason here is low quality coal, which means higher consumption. See, China has ramped up coal production in order to avoid energy shortages, but the quality of coal that is being mined has gone down significantly. You can think of it like making a coffee with weaker beans, so to speak. You need more to get the same amount of strength, right? That's exactly what is happening. And this means China is burning more coal just to generate the same amount of energy, which is driving up both consumption as well as emissions. The second big driver for coal is India's balancing act. See, India's coal demand has grown by 8% in the year 2024, which makes us one of the fastest growing coal markets in the entire world. But here is where things get a little more interesting. India is also pursuing one of the world's most ambitious renewable energy programs. We aim to install 500 gigawatt of renewable energy capacity by the year 2030, which is a target that would place us amongst the global leaders in clean energy. Now, at the same time, India is also building 50 gigawatts of new coal power plants. It's like we are preparing for two very different futures, one that is powered by renewables and the other that is powered by coal. Now, one of India's biggest challenges is that coal mines are concentrated in a few areas, but the demand is spread across the entire country. And to solve this issue, we are expanding coal transport by rail from 64% to 75% by the year 2030, with 38 priority rail projects already in the works. Now, this will make coal transportation much faster, cheaper, and more reliable than it is today. On the renewable side, we in India are betting big on battery storage. The cost of batteries has dropped from $450 per kilowatt hour in 2021 to just $200 per kilowatt hour as of today, which makes it much more affordable to store renewable energy for later use. India has already tendered 16 gigawatt hours of grid-scale battery projects, and some of them have already become operational. Now, this could manage the ups and the downs of renewable energy, which reduces reliance on coal in the long run. Now, while we're at it, let's also talk about the global trends in this space. Let's start by talking about coal's pivot to Asia. See, the geography of coal trade is shifting dramatically right now. After Russia's invasion of Ukraine, many Western countries have cut ties with Russian coal. In response to it, 84% of Russia's coal exports now go to Asia as compared to two-thirds just a couple of years ago. But this pivot, let me tell you, is not at all seamless. Russia is currently struggling with infrastructure bottlenecks because it's not easy to suddenly reroute massive amount of coal shipments from Europe to Asia. The second global trend I want to talk about over here is Asia's emergence. See, while coal use in regions like the European Union and the US is declining by about 12% and 5% respectively in 2024, emerging economies in Asia are seeing exactly the opposite trend. ASEA and countries like Indonesia and Vietnam could see coal demand grow by 5% annually through 2027, which is driven by rising energy needs and limited alternatives. The third global trend I'll talk about is production, which is currently happening at record levels. See, the three largest coal producers, China, India, and Indonesia, all reached world record production levels in 2024. Indonesia, in particular, has become a major player that is expected to export nearly 500 million tons of coal this year, which is a feat that no other country has ever achieved before. So, with all of this said and done, it is also important to take a look at what the future really looks like when it comes to coal. See, the IEA predicts that global coal demand will plateau at 8.87 billion tons by the year 2027, but there is a big wild card over here: weather in China. See, extreme weather like heat waves or cold spells could swing coal demand by up to 282 million tons in one single year. Now, to give you some context, that is equivalent to the entire annual coal consumption of major countries like Germany and South Korea both combined. So, the big takeaway for you and I as investors is that the shift towards green energy is not as straightforward as we hoped. While OECD countries like those in North America and Europe have halved their coal consumption since the peak, emerging economies are facing much tougher choices. They need to balance economic growth, energy security, environmental concerns, and a lot more things, and that is not at all an easy task. China, for example, is building a 220 gigawatt new coal-fired power plant, even as it's leading in the world in terms of renewable energy deployment. India is also doubling down on both coal and renewables at the exact same time. Now, these of course are contradictions in a manner of speaking, but they also greatly reflect the complexity of real-world energy transitions. So in short, coal is not disappearing anytime soon. Its role in the global energy mix is very well evolving, which is shaped by economic realities, technological progress, and political decisions. With that, let's move on to the second story and talk about a pump and dump case that has recently unfolded in the Indian stock market. Now, imagine this: a company that you have barely heard of all of a sudden becomes a talk of the stock market. Its share price skyrockets and grows to 105 times in just one single year. The company claims to have received massive orders and they promise free shares to new investors. Now, I'm sure if you just listen to this story in isolation, it sounds too good to be true, and probably it also is. But that is exactly what happened recently, and it serves as a textbook example of why investors like you and I need to stay very, very alert. See, a company with little to no business activity made headlines for its rapid rise on the stock market recently. And in a very surprising move, the company also announced that new investors would receive free shares for the company. Now, naturally, this caught everybody's attention because, of course, who would not want free shares? Now, on the surface of it, it looked like a generous gift from the company. But if you dig a little deeper, it was not at all generosity. It was actually a strategy, and a very, very carefully planned one. The company's promise of free shares were actually a bait. By giving this attractive offer, the company aimed to attract more retail investors into buying its shares. And I'll tell you why the strategy even worked. See, when more people buy shares, trading activity increases. Now, this creates a buzz in the market, which makes the company look like a hot investment. In addition to this, more the number of people who own its shares, the higher the official shareholder count becomes, which is, by the way, a metric which a lot of companies use to show their popularity. But the thing is, the real motive here was insiders, which are those who already owned large chunks of the company's stocks, and these insiders were preparing to sell all their holdings. They basically wanted to offload all their shares at inflated prices and pocket massive profits. Now, this entire setup was almost like a time ticking bomb if you think about it. When insiders start dumping large amounts of shares, it usually causes the stock price to crash. Retail investors who were drawn in by the promise of free shares and the hype would have been left behind with massive losses. You can actually think of it like being invited for a party where the host leaves midway and takes all the food and drinks with them, and all you're left with is the bill. But thankfully and luckily, India's stock market regulator, the SEBI or the Securities and Exchange Board of India, stepped in just in the right time. SEBI intervened and stopped the company from continuing this dubious scheme. The regulator's move prevented what would have been a financial disaster, so to speak, for many small investors. SEBI essentially called out the company's tactics and put measures in place to protect retail investors. And the story highlights a very critical lesson for you and I as investors. Always do your due diligence. When a company with no significant business suddenly starts to claim massive success, it is always and almost always a red flag. And in this case, if the stock price climbs by 105 times in a particular year, it's not just an ordinary red flag, it is a big one. Now, free shares might sound tempting for sure, but as the saying goes, there is no such thing as free lunch. Usually, these schemes are designed to benefit insiders, not everyday investors like you and I. So, before jumping into an investment that seems too good to be true, please do take a step back, research the company, understand its financials, its past performance, and whether its claims make any amount of sense. Also, it's not the first time something like this has happened in the market, and it won't be the last for sure. Stock markets around the world keep seeing cases like these where companies manipulate investor sentiments to their own advantage. Regulators like SEBI do play a crucial role in keeping the markets fair and transparent, but investors like you and I also need to stay informed and cautious. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Indigo, which is India's largest airline with 427 aircrafts, is wet leasing 6 Boeing 787 planes to address surging international travel demand. Now, this follows its April order of 30 Airbus A350 aircrafts, with delivery starting in the year 2027. Second, the Cotton Association of India or the CAI has requested 500 crore rupees in the 2025-2026 budget in order to promote drip irrigation. Now, this initiative aims to boost yield in rain-fed regions which contribute 67% to India's cotton production but face water scarcity. Third and the final one for the day, prepaid wallets saw a 20.4% decline in the year 2024, dropping from 144 crore in January to 114 crore in November 2024, with a 16.7 year-on-year fall. Regulatory action led to 42% decline in Paytm Payments Bank's wallets, while Airtel Payments Bank saw a 48.5% year-on-year drop. That's all the news and stories I have for you today. I hope you enjoyed the show and maybe learned something new from it today. I'm your host Anurag Bansal signing off. I'll see you on Monday. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.